hey, I will gladly choose a 3.5% loan over an 8% loan any day of the week.
I'll take it too.
Hi, and welcome everybody to the Housing Tips. It's the show where we talk about housing information, housing news, and everything in between. I'm your host, Eric, and joining me once again is my co host, Jesse. How are you today, Jesse?
Doing good, brother. I think you were surprised that I could hang on the golf course, huh?
Fantastic. Yeah, he did a great job, man. He was definitely just surprising me. He parred so many holes and he never plays. So I
I,
know.
I never played before. He actually taught me how to play. So I think I got a good teacher, man.
Thank you, thank you. I try with what I can. But speaking of teaching, that is the topic of today's video, Jesse. Do you want to know what the topic of today's video is?
What is the topic?
Yeah,
Do I know?
yeah. Do you? Well, obviously, you know.
I thought you were asking, like, should I guess? But today's topic, I think we're going to go over scenarios, right? Things to different scenarios in regards to loans.
Yeah, definitely. That's exactly. Jesse hit it right just on the head. So we're actually going to be talking about three different scenarios to help prospective buyers that are looking for home loans, a little bit of backstories of three different people, and then Jesse's going to go in and guess which home loan would be best for them. A general idea. This video isn't in depth. Of course, we're going to make more in depth videos talking about home loans even more. But for today, I want to do something general, go over a few scenarios, play a little game with Jesse, and see if we can stump him and possibly, get some more information about different types of home loans for first time buyers, single individuals, people who own multiple properties. How does that sound today, Jesse?
Sounds good. You won't stop me, brother.
Awesome. Well, today then we wanted to start with our first person, and I'm going to go ahead and read the description, and then Jesse's going to choose what a general good home loan option is for this person. So, Tim is a 30-year-old veteran of the Air Force. His wife, Megan, is a school teacher. They combine to make a decent amount per year. They have a decent credit score with some money to put down. He would like to live in a medium-sized city with his three other kids. Jesse, now what type of home loan would be best for that? And why don't you go into a little bit of depth about that?
Yeah. Already like in the first sentence that you said veteran. So I'm gonna go VA loan right away, 100%. The benefits of the VA loan, there's no down payment, right? Like you could save your savings or other expenses for like other investments. Even if you already have some money saved, like that's huge. Uh, in the VA loan, there's no PMI. And so they don't require it. So that's going to save you hundreds of dollars per month. And people will ask, what is PMI? Private mortgage insurance. That's insurance that protects lenders in case you default on the loan. Typically, it's required if you're giving less than 20% down because you give a lower down payment, you're a little bit of a higher risk to lenders. So that PMI kind of mitigates that risk. Cost of PMI 0.3 to maybe like 1.5%. So it does an impact on your monthly payments. So VA loans don't require it. So you're going to save hundreds of dollars per month. VA loans also come with lower interest rates compared to like conventional. So you're going to save there. And the credit requirements are usually a little bit more flexible. And so it makes it easier for them to qualify for a loan, get a better rate. VA loan, 100% for this family.
Awesome, Vila. I did have one question though. For PMI, as someone who has PMI on their property, what are some ways to remove PMI once you have a property or once you purchase the house?
Yeah, with PMI, I mean, once you reach like that 20% equity, once you kind of like pay down your mortgage, your equity in your home reaches 20%, you can have that PMI removed. In your breakdown, as you're like filling out and signing your documents, you'll see by what payment is it going to be removed. Sometimes it gets automatically, other times you have to request for the PMI cancellation. Most lenders are required to automatically cancel when that loan balance reaches that amount.
Oh,
Mm,
interesting. So it's something that could just happen automatically if you just keep making your payments?
yeah.
Wow, that's awesome.
Also, if you refinance your mortgage, if your home value significantly increase, you can refi so you can achieve that loan to value ratio and remove that PMI.
Awesome. No, that's fantastic news. I didn't even know about that. I really think that is super helpful for anyone that has to get PMI on their first loan. So just over time, it eventually will go up. And then, after a certain amount of time, when the value of the house reaches it, you could just lose the PMI. That is fantastic to know. One other question I did have before we switch to our second scenario is that of assumable mortgages. I know you wrote a note about that. Could you go a little bit more deep into that?
Yeah, assumable mortgages. The benefit of those loans that, let's say, like in the future, you have a great structure of the loan, someone else is able to, assume that loan from you. And so that makes it really, of interest to the buyers, like, hey, I'm able to assume this loan at this great rate, at this great, number wise, and they can coordinate with the seller in regards to assuming that loan, or adding, other like difference in regards to cost, and makes it kind of like a win-win scenario.
Wow, that's fantastic. I didn't even know about assumable loans. That's actually something we saw on social media recently. There was a big craze about it because of the high interest rates. Some people who are locked into extremely low rates, there's options out there to assume the loan. I know there's a lot of hoops to jump through, but hey, I will gladly choose a 3.5% loan over an 8% loan any day of the week.
I'll take it too.
Awesome. Well, Jesse, that was fantastic for the first scenario. Are you ready for the second scenario?
Ready, brother.
Awesome. Let's do it. So I'll go ahead and read the description. So Sally is a 28-year-old accountant living in Austin, Texas. She has never owned any property before and would like to purchase a starting property. Sally does not have too much money to put down, but has around 5 to 10%. She does have great credit, great income, and great history of making all of her payments on time. Now, Jesse, what do you think would be the best loan for that person?
Best loan. You said not enough to put down. So I think I'm gonna go with like a FHA loan, a first time buyer. Uh, FHA loan, first time buyer. Usually you'll hear that interchangeably. Um, the benefits of that, you're able to do a low down payment. Typically, the down payment is 3.5%. If Sally can do 5 to 10%, I think this makes home ownership more accessible for her, since she's a first time buyer. Usually there's flexible credit requirements, based on the scores, and closing costs. Usually there's lower closing costs, in order to make it more attractive for the first time buyer compared to conventional loans. So she'll save up front. And just FHA loans also allow for a higher debt to income ratio compared to the conventional. So she'll be able to, qualify a little bit easier if there's any like issues in regards to the finances part.
Oh, interesting. Now, I did have one question though. There's something I always hear about FHA loans, and that's the whole thing about PMI. Is it true that PMI stays on the loan for the entire loan if you have an FHA loan?
Well, the PMI, usually there's like upfront, like the MIP that they say, and then duration of it. Uh, Unlike conventionals where PMI can be removed once you reach, the MIP on FHA loans is required for the life of the loan. So if you
Ah,
put less than that 10% down, if you make a down payment of 10% or more, it might be canceled after a certain amount of years. So there's kind of like, mm, at times no option for the removal if it
mhm.
doesn't meet that criteria. So you'll need to refinance to kind of remove it in that scenario.
Interesting. But it is a great way of getting first-time home buyers into a home because there's a lot more flexibility with the debt to income ratio, with
Yeah.
the income requirements and all that information.
Yeah, because the other ones might be a little bit more stricter, more harsher, wanting someone with more, just kind of reliability or just kind of income. So that one will be able to be easier for you to kind of get your foot in the door.
Interesting. And that's fantastic to know that there's different options for different folks. So our first person was a veteran of the Air Force. Our second person is a 28-year-old accountant, first-time home buyer. That's great to know that there's different options for different folks because not everyone is just cookie cutter and is just that perfect prime person looking for the next house, looking for a bigger house, a big expensive house. It's fantastic to know that there's different options for people.
Yeah, yeah.
Awesome. Now, moving into our third scenario, Jesse, you did fantastic on the first two. Let me see if I could get you on the third one. Jesse, do you have any questions or anything before I move into our third scenario?
I'm on a roll, brother. Let's keep it going.
Awesome. Okay, so let's get started on our third person scenario and description. Roger and Allison are 45-year-old upper managers at Tesla Motors in Austin, Texas. They own a current home and would like to upgrade to a larger home to have their family members live with them. They have great credit, great income, and a large down payment since they're going to be selling their current home for their next home. What kind of loan, Jesse, would be best for them, and what are your thoughts about that?
No, yeah, I got distracted. I'm seeing the trend. Shout out to everyone in Austin, Texas. But for them, I mean, I hear the standard, the conventional loan. You know, benefits of the conventional loan. There's no mortgage insurance, like we had talked about. They're gonna have that large down payment, and so typically that 20% or more, so they can avoid paying for that PMI. And they're gonna save a lot more money on their monthly payments. They have Sounds like they have really great credit, really great income, and so they're likely going to qualify for whatever is the best interest rate that's available. When people a lot of the times tell me like, "Hey, like, can you estimate for me like how much would it be for this property, my mortgage?" It depends, right? It depends on how much you're going to give down. It depends on your credit. And they're like, give me a ballpark. Well, if Roger and Allison here, they have like really great credit scores, they're going to get the best rate. And if you have a lot lower credit score, you're not going to get that same rate. So big difference in regards to interest rates and your credit score. Usually conventional loans is a lot more like flexible loan terms. And for them, maybe they want a 30-year loan, typical. Maybe they want a 15-year. Maybe they're able to just kind of plan to pay off their mortgage faster. Not sure. Everyone's in different scenarios. And with conventional, you're able to go to higher loan limits as opposed to FHA. Usually there's a certain kind of criteria in how much they can lend. And then you have more property options. Conventional, when it comes to the appraisal and inspection, they're a little bit more, lenient. As long as the property's in movable condition, whereas FHAs are a little bit more stricter. And then with the conventional, you can purchase for investment home or vacation home or something you're wanting in the future. Whereas FHA, it has to be owner occupied, and you have to, be in the property.
Definitely. And we do not condone at all anyone doing mortgage fraud. I know that's a trending topic on social media to get an FHA loan and then rent it out to Airbnb the next day. We
Yeah.
do not recommend that. That is mortgage fraud, and that will end you up in prison.
I've heard of people
Yeah.
who like get a loan like that, or then they kind of leave a bill under their name and try to rent. No, like I don't provide that type of advice. Like
No,
it could be
definitely.
really serious, like the fines, prison time, and you're thinking you could just kind of get away with stuff, but pretty serious.
No, definitely 100%. Well, as always, Jesse, I wanted to thank you for your time. Is there anything you want to summarize with this three videos? I mean, with the three scenarios that you would like to end the video on?
No, yeah, I know it's at times it can feel a little bit daunting, but there's a lot of ways of how to structure it. There's a lot of, different loan options that might be best. And so it's good to kind of go over those potential scenarios, like with your lender or with your realtor, and seeing, you know, what might help me if it's this program for the less down, or this one so I can avoid this cost. And um, just so you can kind of brainstorm and see, what'd be the best option for you guys.
Definitely. No. And words of advice from Jesse, as he's been in the market for over 10 years now as a real estate agent. But as always, thank you so much, Jesse, for your time. And thank you so much, everyone, for listening. If any of this information seems of interest to you, please consider liking the video and subscribing. But until next time, thank you so much and have a great day.
Anyone you said,